I'm George Latham, managing partner. As you probably know, we've got Ted Franks, the fund manager, one of my other partners, with us also this morning, and Rachael Monteiro, our stewardship and climate analyst, is joining us for the second part of the presentation, which will talk about the development of our stewardship strategy and process, and how we focus on quality over quantity in that area. So without further ado, I'll hand on to Ted, and we'll go on to the strategy review and outlook. Thank you, Ted.
Yes, great. Thank you, George. And I think some of you who are on early may have seen a couple of sneak previews of me sitting here with a video. You'd think by 2023 we'd know how to operate Zoom, wouldn't you? And with the fire alarm too, it looks like it's a promising day for technological issues. So hopefully it'll hang together just about. Right. Yes, thank you. I'm Ted Franks. I'm the fund manager of the sustainability strategy. I'm going to talk through, in fact, two sections here. One is a strategy review, and the second is the outlook section. This is the fourth quarter of 2023 review, but actually what we've decided to do is talk about the whole year, as often is the case in fourth quarters. And in addition to that, some of the themes and trends that I'm talking about in terms of the performance of the strategy and the universe, in fact, and impact investing kind of more generally are longer term ones, which have really been in place since about 2020. And they were covered in a little bit of detail in the annual investor conference. So apologies for some repetition there, but we're just trying to make sure that all of our investors are clearly receiving the message. And obviously interspersed with that, we'll talk about specific stock examples as well. And then, as George said, I'll hand over to my colleague Rachael Monteiro to give you some of the really good stuff we've been doing on stewardship at the end there. So on to the review. And we had a positive absolute return over the last 12 months in 2023, but unfortunately over the 3-year period, it's been much closer to flat. And as relative to our benchmark, which is the MSCI World, which is a global equity benchmark, and as many of you are aware, not exactly a perfect measure for us, but the best one that there is, it has been a tricky time relatively. And that's why we want to try and put that into a bit of context today, and so talk about some of the factors which are behind that. And some of those are sort of macroeconomic and market factors, and some of those are related to the markets, the industries, the real world economies that we invest in as impact investors. And we're trying to cover both of those as we go through today and give you examples about how that's impacted the stocks. So starting with some of the macroeconomic backdrop, the thing about 2023 was a continuation of a theme that started at the end of 2020, and that was the inflection in interest rates in the Western world, starting to move from a regime of very low interest rates to higher interest rates. And that has meant trouble for small investors in smaller companies, and we tend to be investors in medium-sized and smaller companies, because that's where you find more of the pure play impactful companies. And also our companies do tend to have a growth bias. They tend to be companies with addressing large growing addressable markets. And as interest rates rise, so the wisdom goes that those companies find it harder to pass on the price rises, the cost increases they're seeing on their cost side. And on top of that, they tend to be a bit more indebted, so they have a higher interest rate cost. And so that's a kind of market wisdom that means you get headwinds in terms of the sentiment and the multiples applied to the companies in our sectors. And moreover, as you can see from this research on the left-hand side here, there's kind of an industrial slant to that as well. So growthier sectors, typically through history, such as healthcare, industrials, consumer discretionary and technology, are the ones which have reacted worst to an inflation and interest rate shock. And that again relates to their kind of growthy characteristics. Now, in this cycle, since 2020, actually the technology picture has been more interesting. And that's been another bit of a relative challenge for us in terms of our performance. And it has been a period in which a very small number of extremely large, historically disproportionately large, never really had this level of market concentration before. Those companies have done very well. You can see from the lines here, they're represented by the dark line on the top, which is an ETF provided, I think in this case, by an outfit called Principal, capturing the performance of those companies. That's ahead in the middle of the broader benchmark, our benchmark, the MSCI World. And beneath it, the equal weighted version of that index, you can see there. And when that's beneath the mainstream version, what that's telling you is you've got this market narrowness. You've got a small number of large companies really doing better than everybody else. Now, of those magnificent seven stocks, 6 of them don't provide solutions to impact sustainability challenges and are therefore not in the universe. Tesla could be in the universe, but is a persistently poor performer on governance, safety, and social issues, and we do find it impossible at the moment to invest in Tesla. So that has been a challenge for us in terms of relative performance. And you can see that manifest here in this slide, which again, more lines for you, I'm afraid. I think we'll stop the line charts fairly soon, but the expression of some of those stylistic factors you can see as the orange line, which is an index called the Mid-Cap Growth Index from the MSCI. And all of these lines, by the way, these are representative indices of some of the areas that we invest in. Then there's our performance underneath that. And underneath that, more interesting still, two of the key areas for impact investment. Cleaner energy, clearly, the great environmental challenge of our time is decarbonisation. Of course, there are other significant challenges as well, which we invest in, but that's kind of the standout one. And then on the other side, on the social side, our largest social theme is the healthcare theme. And what is interesting about this period, 2023 and the earlier years, is that whereas healthcare has traditionally had a more defensive quality, so when some of the environmental themes, which are more economically sensitive, have underperformed, healthcare has helped to provide some balance. It likewise has not had a good time in this period. And so we've been investing in industries facing headwinds. And that is reflected in our attribution. This is the actual performance of the strategy now, whereas previously we were talking about indices that represented kind of the key factors that we're facing off against. And you can see there, cleaner energy and health, the big detractors, sustainable transport, water management obviously have a corollary in a relation to decarbonisation. So does resource efficiency, actually, but our performance there was better due to a couple of specific stock successes. And why is that? Well, there's a few things going on, but one of the key reasons is that longer term optimism around these stocks and the growth pathway they have, which is the key to owning them and why you would be invested, is under more doubt as a result of a kind of policy backlash led by populist politicians following a narrative which is relatively straightforward. It is a cost of living crisis without doubt, and it's easy to label the green agenda as unnecessary expense, and there's lots of demands on budgets all over the world. So we here in the UK have seen it fairly clearly, although it's in the past now, but obviously in 2023, there was a fairly significant step back from the UK leadership on issues like support for offshore wind, the phase out of internal combustion engines, the phase out of gas boilers. Over in the US, the white document in the middle is effectively a policy manifesto for a second Trump term. It's from the Heritage Foundation, and that again is not supportive of environmental issues, although it is fair to say that the landmark American legislation, the Inflation Reduction Act, is more sensitive for the potential Republican leadership, because actually a lot of Republican states are very supportive of it. We can talk about that a bit later, but generally the direction would not be helpful in a second Trump term. And the right-hand side, European analog of this, that person is Robert Habeck. He's the German economy minister, and he's got a scrunchy face because his boiler rollout, gas boiler phase out, has been delayed. And again, we've seen some quite striking increases in populist support in Europe, and that is not helpful for companies and individuals who want to make investments in the transition, and whether or not that's going to be supported going forward. And as a sort of landmark to that, and we only have one slide on this topic and there could be more detail, but just to give you the summary of our thoughts on COP28, which happened after our investor conference, so at the end of November and in December, in Dubai, controversial where its location was, and generally expectations fairly low. Actually, there were some highlights from it, some bright spots. We did get fossil fuel language into the text. There is a commitment to renewable energy generation. There were points about wealth transfer and funding, which were positive as well. But generally speaking, what you're looking for from COP is a general tightening and increase of ambition around national targets to decarbonize. And on the left-hand side, we have often used this excellent German NGO Climate Action Tracker to sort of demonstrate this, because they have this nice analysis which translates their view of the policy world to what it would mean in terms of degrees of centigrade of warming, with the target being that blue line at the bottom there, 1.5 degrees. And it's really that green downward arrow, the target gap. So they updated their thermometer for COP28, and actually they said, we've slightly gone backwards here, we've gone back now. It looks like the target is more like 2.1 degrees, not actually because any policies have been weakened per se, but actually climate change has gone faster than people anticipated, and the backing behind some of those policies hasn't been as secure as they had anticipated. So you know, there is a COP along every year. Hopefully next time we'll start to get a bit more progress as well. But this is a general headwind for a lot of the themes that our companies face off on. And that has meant, switching to some stock-specific examples, and we had a big negative contribution in the cleaner energy theme this year from our residential solar names, Enphase and SolarEdge. The policy support situation there in the US, you know, could be better. It wasn't weakened in the same way, but an additional compounding factor which relates to the things we've been talking about, they struggled a lot with their demand in the second half. That's the light green line on the left-hand side when interest rates yields start to rise. What I've done there is inverted US 10-year Treasury yields. If this is too complicated, do ask me questions later, but the point is, see that correlation as interest rates rose through the third quarter. A lot of homeowners who were ready to spend money or borrow money to install solar panels on their roofs didn't do so because it became more expensive. And that was another feature, another headwind for the cleaner energy space. That's, of course, despite the fact on the right-hand side, you can see the different direction of travel for utility provided electricity and solar PV in the US. So the long-term picture there remains very supportive. So switching now to health, where we've got 3 slides to share with you, telling this story through some of our stocks. 2023, a continuation of a slightly tough period for a significant exposure we've had in the strategy all the way back now. Life sciences tools, I mean, as long as the strategy's been around, we've been invested in these names. They've consolidated into the big 3 that we have here, and they have struggled for organic growth in 2023 because whilst there are other things going on in the healthcare sector, and we saw the index had underperformed, and there's, you know, challenges in terms of drug pricing, there's also the impact of the very successful obesity drugs and the sort of ripple effect that has on the rest of the sector, and various other issues around medical devices as well. But in the area where we're exposed, particularly in terms of drug innovation, we've seen this phenomenon that there was a great deal of investment in new equipment and consumables after COVID, and there's kind of an inventory clear out process going on that's reducing demand for the products that our companies sell, and that's hit in 2023. But I would say that that's not been a universal experience in that supply chain either. We have a couple of other names which are related to it. As you might imagine, we find drug discovery a very impactful area, and we have lots of exposure to it. And one of our names, ICON, a contract research organization, had a very good year. This is included here because it's one of our top performers in the attribution. And it did that because, as you can see on the right-hand side, it managed, actually, despite that sort of organic slowdown of the tools side, it managed to increase its backlog and keep that backlog depletion time up above 30 months. The market was delighted with that. It's good execution. It's a great company. It's also because they have an outsourcing trend towards contract research still continuing, and there's also a consolidation piece there too. The other reason the market loved the stock is that it's paying its debt down. It bought something called PRA in 2021, and you can see it's done a good job of getting that debt down in a rising interest rate environment. Lastly, on the health side, on switching back to negative now, one of our big negative contributors this year, Globus Medical, a spinal devices company. We'd held it for a year before February last year, when it did something we'd explicitly asked it whether management they were going to do, and they'd said they wouldn't, and that's bid for the rival NuVasive. Where we looked at these companies, we looked at NuVasive as well and thought that Globus was more interesting. You can see on the right-hand side, it's a much more R&D led, much more innovative product company. We really liked its positioning there. We think the merger is tricky. You can see on the left, there's a lot of overlap between these 2 companies. Unfortunately, obviously we sold quickly on the news. Unfortunately, the stock moved almost immediately. It's stayed down since. We're waiting to see how the combination works out because we do think it's an interesting market, but that was not a success in 2023. What was a success, and staying on the theme of mergers and combinations, this news actually broke after the year had turned, but lifted Ansys to one of our top performers in the fourth quarter and through the year as well. And this also showed up in that resource efficiency, good performance on the thematic attribution. So we've had Ansys since 2015. It's a leader in real-world simulation, using computers to help designers create products which are more efficient. It's been a great company to own. We've had a good performance from it. And you can see we've circled in red when Synopsys goes to the market to tell the world about this merger, the first thing they call out in Ansys's growth is its sustainability contribution, and that's true, and that's really been a big driver for this name. Synopsys itself comes more from a semiconductor side. the combined entity probably isn't going to pass our threshold in terms of how impactful it really is. We will have a look at it and see. They're looking at this new idea of a silicon to systems simulation leader. So that was a stock success for us, though obviously sorry to leave ANSYS. And so with that, onto the last review of the year on the positive side, things that did go well. And this is an interesting theme which we've spoken to quite a lot of clients about. I'm very happy to speak to anyone else who hasn't sort of picked up this message. But if you think about the pace of climate change and the increase in severity and frequency of very adverse weather events, we're moving into a phase where we go from having the capacity to focus on mitigation and reducing CO2 emissions to having to adapt to a changing world more rapidly, a world that's changing around us. You can see on the right-hand side, slightly stale numbers now, but still very good ones, explaining how if there were a notional pot of the money being spent on climate change, the mitigation piece is going to have to reduce to make more space for the adaptation piece. And on the left-hand side, you can see some of the reasons from that from the US insurance market, and another very good NGO called First State Foundation, just showing just how extreme some of these increasing costs have been for fighting wildfires in the US. And so that lifted names such as Arcadis, our consulting engineer, and Train, which makes heating and ventilation. And it also lifted Advanced Drainage Systems, which makes storm water management system, well, equipment, products like the pipe you see going into the market there. Predominantly serving the southeast of the US, so really coping with an increase in hurricanes and extreme weather. And on the right-hand side, what that means in terms of the revenue growth opportunity. And they've particularly done this very good job with their margin. They're the largest recycler of PET plastic in the US, so they've got a great sustainability story all around. And they're part of this adaptation growth trend, which I'm sure will be a very successful place to invest over the coming decade, without doubt. Okay, so that maybe is a neat sort of segue to talk a little bit about the future. And we've got a few slides here, just a couple, first of all, on some of those kind of market and macroeconomic sort of headwinds at the top, and then some sort of longer term, you know, how we think about our investment positioning as well. And obviously happy to take any questions. On the macroeconomic side, so what happens to inflation and interest rates? When do we expect there to be a more positive environment for sort of smaller and growthier companies? We've already seen in the back end of 2023 quite significant volatility when it looked like interest rates were going to drop, then the strategy did very well, and vice versa. The picture, though, in terms of inflation expectations isn't straightforward. They did peak in the middle of 2022. There was some anticipation that that is quite rightly was a COVID supply chain disruption stickiness that would unravel. But there are longer term trends here around, obviously, unfortunately, the world has significant conflicts going on at the moment. And there's also a big question about the decoupling of the Chinese supply chain. And so actually, even though inflation expectations came down at the start of 2023, they then sort of stabilized. And our view now is that we'll have to be waiting until later until 2024 before a kind of meaningful pathway for reduced interest rates starts to provide an opportunity for growth stocks. And even that, again, we're not big macro prognosticators, so we don't want to sort of go too far ahead on that. But that would appear to be the direction of travel. And then similarly, again, not being always with the caveat, not being sort of specific macro prognosticators, we are exposed to industrial confidence. We have a lot of industrial companies and also technology companies. That's where impact is. Those companies are exposed to recessionary risk. This is the Purchasing Managers Indices. And again, a KPI I think we share with you fairly regularly. You can see we're still at low levels now. It's definitely quite a large bit of the industrial world that's sort of in a recession and certainly anticipating a recession. Our view there, again, this is cyclical. We know that confidence will recover. Companies will find new bases and then build up from there again. But this is a sort of 1 or 2 year view before we get a bit more constructive and get a bit more of a tailwind from these areas. But our positioning is always longer term than that. And I talked earlier on about the biotech down cycle. You know, we continue to be very confident about the next decade in terms of servicing biotechnology research and drug discovery. You can see the number of drug candidates and research pipelines just continues to grow. And the texture of that, which many of you will be aware of, is the growth in so-called larger molecules, biological drugs based on mimicking actions of the human body, as opposed to the older established technologies of small molecule chemistries. And that really is a proliferation of really quite exciting technologies. And we see that continuing as a very sustainable investment trend. You can see on the right-hand side that the sort of funding cycle, which caused part of the problem, peaking there in COVID, but actually even those numbers now look as though they're on more stable base, and that helps companies and industries to stabilize as well. So the long-term view there is still that this is going to be a good place to invest. And then on the environmental side, and I realize obviously I've been going for a little while, so we're near the end, don't worry, but just on the environmental side and the clean energy picture, there is obviously a lot of noise at the moment, and it can feel very negative. But our view is that actually in the 20 years we've been running the strategy, it's probably as good now as it has ever been, in the sense that the sensible market participants and policymakers realize what the pathway is. There is a general acceptance, not only that climate is changing, but the causation of it. And even the noisy politicians realize that there are opportunities there and things they must do. And we've used the example here of the EU. You know, in 2019, they had already really finalised the policy pathway around the easier decarbonisation sectors of energy, transport and buildings. In 2022, with Fit for 55, they'd got on to starting to lay out what might happen in shipping and aviation, some of these trickier areas to decarbonise. And of course, the more certainty you have on a regulatory basis, then the easier it is for companies to go out and do what they do effectively. So we think actually now a lot of those key issues are kind of settled. And as brilliantly demonstrated by our friend Kingsmill Bond from the Rocky Mountain Institute at the annual investor conference, the reason that you can have that confidence is a lot of these technologies now are so well established and the price has come down so markedly that they are in a very rapid growth phase. And we are talking about a different paradigm for clean energy and environmental investing than we have had, even if the near-term story is very noisy. So thank you very much for listening. I will take questions later on. And for now, I'm just going to stop sharing and hand over to Rachel.
Hi there, thanks Ted. I'll just start off with a little bit about what we've observed in the last 12 months. In 2023, stewardship became a core activity of asset managers and asset owners, thanks in part to regulatory developments such as the FCA's sustainable disclosure regulations and evolving definitions of impact investing. The result is what we might call a stewardship stampede. Many asset managers have rushed to respond to this increased focus on stewardship, with some tripping over themselves to demonstrate a hype of activity. A recent report by investment consultant Reddington, for example, found that one asset manager reported over 10,000 engagement actions against 2,000 companies in 2022. As we all know, prioritising quantity over quality is not without consequence. You may be familiar with recent headlines regarding concerns around asset manager stewardship for reasons including misalignment with client values, lack of consistency in voting activities, and under-resourcing and low-quality efforts. Evidently, the investment industry is still figuring out what constitutes good stewardship. And while we might not be clear on what this looks like exactly, it seems as though 2023 has been a foundational year for identifying what it is not. The last 12 months have been similarly evolutionary for WHEB when it comes to stewardship, albeit in a different way. And it's important for me to point out here that while we closely watch market developments, they are not the sole driver of our work to improve our approach and the broader system, which predates what we think of as the stewardship stampede. Focusing on what we have done in 2023, though, our work is centred on elevating the overall quality of what we do, as we want our stewardship to be methodical, effective, and clear. So looking at how we're being methodical in more detail, at WHEB we see stewardship as fundamental for fulfilling our mission as positive impact investors. Our ability to influence both investee company behaviour and the broader financial system is vital for our investor contribution to positive impact. As our team has grown, we've been really careful to remain considered and methodical in how we carry out stewardship, and this has really supported us in elevating the overall quality of our work. I'm going to take a moment to talk through each of the components of this slide in just a second, but firstly I wanted to show you it as a whole, because the way we see it, there is really a lot more to it than just engagement and voting when it comes to an investor contribution. Looking more detail at the first half of the chart, to begin with though, we can see that the investor contribution begins with looking at inputs. As investors, we face a vast amount of choice when it comes to selecting topics that we could possibly address through our stewardship work. And this applies both to our proactive and our reactive engagements, as well as policy aimed at the broader financial system. Our process has always been to identify and focus on the most material issues at an individual company level. However, it can sometimes feel as though there's a burden to demonstrate action on an increasing number of external agendas across the portfolio, even where they are not as relevant for long-term value creation. WHEB's view is that we, as investors, are best placed to consider issues in the context of detailed analysis of our companies. Embedding stewardship in the investment process means that our objectives and priorities are closely aligned with their long-term success. In fact, WHEB's investment process has really been built around becoming knowledgeable and also supportive long-term owners in order to help our companies maximise their impact. And we see this as being foundational for being effective in our stewardship work. So hopefully that gives you an idea of how our investment analysis contextualises all of our engagement work. The chart on the left here shows a simplification of the feedback loop that is on the other side of this. So basically what I'm trying to say is that the insights gleaned from our engagement further enhance our investment analysis. The chart also shows that two other important processes occur along the way. The first being escalation. So this is where we might use tactics such as collaboration or voting rights. These are necessary where progress is slow or non-existent. And the second is reporting. So communicating our activity and outcomes back to clients, which also signals our intentions and expectations to the broader market. I think that this shows that there's a lot more to our stewardship work and our investor contribution to positive impact than just engagement and voting. And being more methodical in how we approach this work, we think makes us better enabled to become more effective in what we're doing. So then moving on to the effectiveness, the second key area of focus of our work in 2023. How do we measure this, and how do we go about measuring and kind of assessing outcomes? We think it's our job as asset managers to help show the correlation between what we're doing and real world outcomes. And that's not to say that we feel outcomes should be attributed to us. We don't think that we can possibly claim this, especially when they are almost always the result of multiple actions from a variety of stakeholders. But it is important not to focus solely on activity. And this is why we've introduced the outcome milestones framework that you can see here in late 2022. And this is really in place of reporting engagement simply as successful, partially successful, or unsuccessful, which is what we did previously. As well as helping us report progress against objectives with more granularity, this has also helped us better assess our effectiveness. Just to walk you through the milestones, you can see that they show an outcome as being either milestone 1, this is where the company acknowledges the issue. Milestone 2, this is where a company might disclose more information regarding the issue. Milestone 3 is where there is a commitment or the company is already developing some sort of strategy or policy to manage the issue. And then milestone 4 is really around us seeing some sort of evidence that the issue is being handled in a way that we feel is appropriate. Whilst in theory there can be linear progression from milestones 1 to 4, and admittedly this would make a very nice neat reporting, we have found that this isn't always necessarily the case. We did some work last year to apply these milestones to our historic reported outcomes all the way back to the beginning of 2018 to the beginning of 2023. And in doing so, it really became clear that it's not that simple. In some instances, companies are already handling the matter and we're happy with how they're doing this, in which case the outcome gets graded as a milestone 4. An example of this would be work that we've done recently to engage Siemens Healthineers. It's a company in our European strategy. We engaged them on biodiversity as part of a collaborative initiative. The company came back to a letter sent as part of that initiative outlining the fact that it's done a materiality assessment quite recently in line with the European Sustainability Reporting Standards. And the outcome of that assessment had concluded that biodiversity was not a material priority, as the company is not real estate intense and not real estate modifying. We felt in this instance that it was a pretty reasonable response. They've demonstrated understanding of the issue and taken appropriate action, and we're happy to grade this as a milestone 4. In other instances, tracking a trend of milestone 2s or 3s, so this is where the company is just disclosing information or talking about plans in place to manage an issue. Just tracking a trend of those 2 milestones over time can maybe suggest that there's been little to no further progress. In reality, what has happened is that the nature of some objectives have evolved over time. Another example of this would be engagement that we did recently with a company called WHEB in our European strategy around net zero. Again, this was part of a collaborative initiative. We felt fairly satisfied after an initial call that the company was taking necessary actions to address concerns. So, for example, it had set intentions to set Scope 3 targets in line with the guidance, what's available, and the company has been feeding into that guidance. The company also clarified its fossil fuel exposure. In our view, this is a milestone 3. There's a plan in place to manage the net zero ambitions, and we will continue to monitor the company over time. However, if we get to about this time next year and there's a failure to set that Scope 3 target once the guidance is available, which is what we're looking for to achieve milestone 4, it's actually likely that we'll be back at a milestone 2 or milestone 3. Equally, we aim to be realistic about what we can achieve. A long-term perspective means that we can be ambitious with our stewardship objectives. However, we are also mindful about managing resources effectively with the aim of maximising our impact. So this means that there are some cases where we choose not to escalate, never mind divest, on the basis that we can't achieve a milestone 4 or even a 3. Prime example of this is on auditor independence. It's an issue that we're consistently voting against management on. I think over the last couple of years, it's accounted for about 10 to 15% of our votes against management at the last couple of proxy seasons. Despite writing to management after the vote set out our reasons for voting against and why we think that this is a really important topic, we've seen very little progress over the years. Our view, though, is that as relatively small shareholders, they're often trying to encourage progress on other pressing matters. We need to make sure that our efforts are both realistic and proportional, even where our ambition remains high. And so that means that an engagement can conclude from WHEB's perspective at any of these milestones. Though crucially, it's important to emphasise the fact that we will continue to monitor the company's performance and management on an ongoing basis. Just moving on to the next slide and carrying on with how we've been working to understand our effectiveness. As I've previously mentioned, we applied the new milestone framework to our historic outcomes with the aim of finding trends over the period. We've definitely got more work to do on this, but there are some insights that I think are worth showing here. And the most obviously noticeable trend is around the amount of engagement, which has increased over time. Really, this is a function of the investment team growing from 2020. You can see the red arrow on the screen there with the addition of Claire Jervis and Victoria McLean. And that's fed through to the number of engagements initiated, which is the kind of tail bar at the bottom, from 2020 to 2022. In turn, we then see in 2023 a proportionally larger number of milestone 1 outcomes, so that's where the company is acknowledging the issue, and then milestone 2 outcomes where the company is disclosing on the issue. Overall, we kind of see a trend whether fewer 3 or 4 outcomes, milestone 3 or milestone 4 outcomes, which as a reminder, these are related to setting strategy or policy to develop and manage the issue, and then evidence that we're happy that it's been handled in that way. And we think that this tracks back to the achievement of these outcomes relating to more demanding asks from the company. So basically, it's easier for a company to acknowledge an issue or disclose information on it than it is to commit to change and then evidence that change. Still, we remain ambitious in our efforts, and we're definitely working towards trying to achieve more milestone 3 and 4 outcomes in the future, particularly as the power of investor stewardship is harnessed and also companies' understanding of sustainability issues continues to mature. Finally, on this, while this data is helpful from WHEB's perspective, we definitely recognise that it's not actually that compelling or helpful to our investors. who are trying to understand real-world outcomes from our stewardship and how effective we have been as enablers of them, which leads me nicely onto, oh, I seem to be going in the wrong direction, there we are, which leads me nicely onto our third area of focus on quality in 2023, which is around being clear. At WHEB, we often speak about our radical approach to transparency, which extends to our stewardship work and includes publishing all of our voting activity in the vote rationales, details of all engagement dialogues, summary statistics, case studies, stewardship reports, and so on. To an extent, this serves as a level of assurance for our clients, but we don't think that this is enough to truly add value. We know that many of our clients don't have the resources to go through large quantities of raw stewardship data, and nor do we think that they should have to, which is why we've been working to improve clarity of our reporting as well as the actual transparency itself. So to talk you through what we can see on this slide, which some of you might have seen at our annual investor conference back in November, on the x-axis we have the alignment of, so the companies that you can see here are the top emitters in the strategy, and on the x-axis you can see how aligned they are with the Paris Agreement. On the y-axis, there's a logarithmic scale showing the absolute emissions of these individual companies. And then the data points themselves, so you can see how the points have changed from 2022, that's the circles, to 2023, represented by the triangles. Linking this back to our engagement is the final step. So one example of this would be that we've been engaging First Solar, a US manufacturer of solar panels, on net zero targeting, especially scope 2 emissions. Through various conversations last year, we learned that the company has set RE100 goals and that it wants to increase the use of renewable power. And actually just a couple of weeks ago, we were really delighted to see that the company has announced that by the end of the year, its Indian operations should be 70% powered by renewable electricity and powered by its own solar panels. On top of this, emissions overall have not increased, which is pretty impressive, as the business is growing at a significant rate. So alignment with the Paris Agreement has improved. You can see the circle as it's become triangle has moved from the left to the right. We think that the systems and processes it's putting in place should also hopefully bring down the absolute emissions, but over a longer time frame, so over the next 5 years, at which point the triangle will then move down as well. Rather than replacing our existing reporting, the aim is for this type of chart to complement it and to show, for example, that case studies are not cherry-picked as best case examples, but rather part of a much broader methodical process to address core sustainability issues. So to wrap up, as we head into 2024, the ability of investment managers to successfully deliver on stewardship will, in our view, depend on considered and methodical stewardship processes underpinned by robust systems, resources, and meaningful reporting. And we think that we're putting everything in place that we can to make sure that we lead on this. And on that note, it's time to wrap up, and I'll hand back to George.
Rachel, thank you for that. That's great. If you can stop sharing your screen now, and we've now got some good time. We're pretty much on the time that we promised. So good timing from Rachel there. And we've got 20 minutes or so to answer your questions. I can see some starting to come up through the Q&A function now. So just as a start off, then obviously in Q4 there was a much stronger market, and we saw quite strong absolute returns and but quite a volatile market as well in Q4. So I just Ted, we know you presented the year as a whole, but just to unpack a little bit more in terms of what was going on in Q4. Can you do that?
Yeah, thanks, George. So Q4, and yes, apologies, of course, we have decided to do the year this time. We thought it was important to focus on the big trends, but Q4, and interestingly, it was quite a microcosm of that. It has a reporting season, the Q3 reporting season coming out in October and November. And so that had an influence on some stock-specific movements, but really across that, as ever, some of the risk factors were just bigger. And so towards the end of October, through October, I guess gloom about interest rate path being higher for longer grew through the market, and we struggled as a consequence. And then there was the meeting, the FOMC meeting on the 31st of October or 30th of October, and then it was, you know, it was a sort of champagne rally into the year end, and November and December were very supportive for us. And I have to say, obviously, we try and invest in these, you know, with this long-term lens. We do find a lot of these movements when our risk factor is very high. It is, you know, it's it's sort of slightly tiresome as a fund manager. Then into the new year, we've gone back to the same, you know, conflict and higher for longer. We've also seen again that concentration amongst the Magnificent Seven increasing as well. So we're sort of moving around away at the moment, which is frustrating. I think we think that probably presages the end of this regime and actually moving to hopefully a reducing interest rate environment going forward. But there are very good questions about inflation. The level of conflict globally now is stunning and, you know, very scary. Having a house view on these things, again, isn't our kind of specialism, but, you know, if you weigh up the sort of the disinflationary trends really of the aging population, which is very, very marked, and potentially technology as well, against which you have, I guess, global decoupling, deglobalization as being the most inflationary trend. I think as we see it, the technology piece of that is kind of probably in the near term going to be the solution for why we don't see more challenges from supply chain disruptions. And actually, the warfare is horrible, but it won't take much of a settlement and some sort of peace dividend there before you start to see inflation, I think, come down more meaningfully. So that's kind of our position. Which again, that sounds like I think all these conflicts are going to be over quickly, which I wouldn't necessarily want to go on record doing that. But if we have to have a view, that's kind of where the view is.
Great, thanks, Ted.
That helps.
No, that's really helpful. Just sticking with things that happened in the fourth quarter. Just obviously we had COP28, the sort of latest round of the climate conference happens annually, so sometimes it gets lost in the noise a bit, but it was quite significant in a number of ways. Are there any thoughts coming out of COP28 and relevance for the portfolio?
Well, I guess specifically in terms of direct stock correlations, always slightly tricky from the big sort of mainstream events like that. I guess our point would be, and based on expectations on the way in, although we saw that actually it was relatively disappointing in terms of making progress, I think there was enough around it to suggest that we are in the right place with our environmental names, and that there wasn't a sort of major hiccup. You'd have seen that if we thought we'd taken our cleaner energy exposure down fairly rapidly if we thought there was a significant problem there. Obviously, there's noise around hydrogen, and we continue to sort of try and look at whether we could position ourselves in that. And obviously, as a fossil fuel hosted COP, they were very keen to sort of push the hydrogen story, but I don't think it really moved the needle for us in terms of what the reality of investing in that space is. So yeah, not an awful lot that came away sort of a direct stock level, and neither an accelerator nor actually a significant decelerator either.
Okay, thanks for that, Ted. That's great. Just to ask one question coming through for Rachel. Rachel, when we engage with portfolio companies, who do we typically end up engaging with?
Yeah, absolutely. So more often than not, our engagement tends to be targeted in the first instance anyway with company investor relations contact. We, as long-term investors, are in the position to have built up fairly good relationships with a lot of the IR people in our investee companies. And also as investors in companies focused on sustainability solutions, a lot of our portfolio businesses also have chief sustainability officers who, like their investor relations counterparts, are pretty engaged on a lot of the topics that we want to talk about with them already. So we find that tends to make pretty productive calls. When we are voting, we tend to vote against management on a lot of routine resolutions. And in every instance where we do that, we will write to the company management, often the chair or CEO to explain our reasons for voting against. So we are really trying to kind of target a whole host of people across the C-suite.
That's great. Thanks, Rachel. And another question about shareholder resolutions we're seeing coming through at the moment. So are there any trends that you're seeing in terms of shareholder resolutions for the forthcoming AGM season, and any themes that are rising up the agenda particularly, and such as biodiversity and the like?
Yeah, absolutely. I mean, I think last year we saw initiatives like the TNFD, so the Task Force for Financial Disclosures, nature-related financial disclosures, and also Nature Action 100. They are really kind of pushing topics like biodiversity up the agenda, and there's definitely a question of whether or not that will manifest into there being more shareholder resolutions in this current proxy season. I'm definitely intrigued to see what happens, especially in light of there being kind of record low levels of support for ESG proposals from last year, especially in the US. When it comes to issues like biodiversity, I think for WHEB, as I've mentioned just now, we tend to see so few shareholder resolutions actually being filed across our portfolio companies. I can't remember the exact statistics for 2023, but I know in 2022, for example, I think across 583 resolutions that we voted on, so all that we were eligible to vote on, there were 6 shareholder resolutions. They were all related to governance issues. So we just tend not to see there being the opportunity to engage on some of these kind of broader systemic issues on shareholder resolutions. And instead, we focus our efforts on routine resolutions and then letter writing, because it means that we can then get in front of the company management and focus on a dialogue, which is where we see ourselves as having more of an impact as a relatively small shareholder. In terms of other topics that will remain important at the proxy season, I think we'll continue to see issues such as shareholder resolutions such as focused on carbon, gender, net zero pay, but I think we quite possibly, having seen ESG get caught up in the culture wars in the US, especially, I think we might see continuing low levels of support for a lot of those resolutions.
Great, thanks, Rachel. That's really helpful. So Ted, just coming back to you for a moment, just in terms of 2023, obviously it's been a tough year in many respects. What would we say the key lessons learned are from our experience over the last 12 months, indeed maybe over the last couple of years?
Yeah, I mean, this is the answer to that obviously is a fairly straightforward one if you stretch it over the last couple of years, and it's very apposite really, because it coincides with regulatory finality, obviously here in the UK with the arrival of SDR, but also with the way that SFDR on the continent is now evolving as well. And that really is understanding the beast better, understanding what it is impact investing is, knowing and looking at our universe of stocks, then looking also now at the growth of strategies which also take a very authentic approach to impact investing, and just really realizing where those biases are. It was a very difficult year for all of the universe of impact investing. Some of those stylistic factors we talked about are very prevalent, and so now we have a lens which we have our work on risk management very ably helped by Sarita Kashyap, and we really are sort of more sophisticated on it. And so there's a question a little bit about how you can sort of move the levers there, but generally a general understanding, the universe's hit rate of outperforming stocks this year was strikingly low. And some of those big factors as impact investors, you have to understand them, and that gives you a helpful frame, and that helps you be a longer term investor and sort of see through the trees for the actual wood of what it is we're doing. So that was really the big takeaway of the last few years. And I think, as I say, I think it's right, because I think naturally what these products are is now being fairly closely defined, and what we're offering to our investors is being better understood as a consequence.
Right. It's a slightly more prosaic change that we made last year, was you touched on really, was the addition of the adaptation sort of sub theme. There's a question that come through just in asking if that'll lead to more focus on that in years to come, and any particular sectors or activities that we expect to come through that increasing focus on adaptation.
Yeah, I mean, without doubt, it will be easier for companies facing off into adaptation to present organic growth rates which are differentiated from market expectations, which is obviously what we look for, impact differentiated growth rates, especially for the period in which there is still this sort of pushback and there's still the last sort of, I think actually, maybe it's too optimistic, but the last few years of there being kind of noise in the other direction, whether or not people will realize that actually these sectors, so whether it is heating and keeping people cool, planning the way that cities and infrastructure is built, actually contributing to making that infrastructure more resilient. And we've got plenty of names, some of them are sort of technological names, either engineers or people providing software. Some of them are sort of hardware solutions. And yeah, it's sort of closely defined, I guess. Internally now we can sort of ring a bit of a bell and say this has got adaptation in it, and that helps. It was previously kind of scattered a little bit across the universe, and I wouldn't sort of classify it as necessarily us going specifically looking, although we may do that. We may do bits of specifically looking, but it will just be much clearer. And the companies, as I say, a lot of the companies are already identified. I would expect that there will always be 3 to 7 out of 40, or maybe even 5 to 10 out of 40 names which are speaking to adaptation, really, one way or the other from now.
Great, thanks, Ted. In terms of the things that we're looking out for this coming year, and obviously, I think more than half the world is voting on in general elections in the coming year, and obviously in the US there's a particularly we've got a close eye on that, and the concern, like we've talked a lot about how significant the Inflation Reduction Act has been and continues to be in the US. If we did see a Trump victory in the US, to what extent could that be under threat?
Yeah, thanks. Thanks, George. So he did come out and openly attack it. I've lost track of when that was. Was that a month or two ago? Obviously, the dynamic here is that the IRA funnels a lot of money into Republican states, Republican voting states. They tend to be broadly deserving economically, needing support. The IRA is a remarkable piece of legislation, outside Trump himself, is really pretty bipartisan. The position that it represents in terms of that kind of nativist homeland economics. I think any other politician you would say, apart from that, it is settled law as well. So if any other politician you'd say, that's just not a fight they're going to take. It doesn't make sense. It's too popular. So then you're left with, what is he going to do? What would he do? And obviously, more broadly, we obviously would prefer it wasn't a second Trump administration. I think stocks wise, you obviously get this big old tax cutting, regulation cutting agenda, and equities, that knee-jerk equities go up. And I don't know the statistics, you get different analyses of whether sort of green stocks do better under Biden or better under Trump, and it's actually much more nuanced. Without question, for long-term progress and for what we're trying to invest in, we'd prefer not to have a Trump presidency. But I'm sorry, that was a long answer to say I don't know, wasn't it? But my sense is it's probably going to be okay, but you never can tell with Trump.
Thanks, Ted. If you were very sure about it, then I'd be worried, I think. But so no, I think that's fair enough to say that. But no, that's helpful. So I think we've got through most of the questions that are coming online as well. There's one last one which I'll just tackle. I'll take myself just very briefly, which was about carbon offsetting through voluntary carbon credit markets and where we stand on that in terms of how we address that with our portfolio companies. And really to say, though, although we have a big focus across the portfolio on net zero carbon and working with our companies to achieve net zero carbon, the first step was really on seeing companies set targets and manage against those targets. But the second step, moving on from that, is really looking to work with our companies to set science-based targets, and that generally will move beyond carbon offsetting to actually taking carbon out in a more fundamental basis. So that's the sort of general approach, but we can take up more detail on that question offline if that's helpful. So with that, we're pretty much on the hour now. So I'm going to call an end to questions there. But if there are any other follow-up questions, then please do contact us. You've got my contact details, my email address. Please do come through, and we're quite happy to come and do one-on-one meetings as well. But it's great that we've had so many people dial in this morning. Thank you very much for your time. Thank you for your support over the last year. And we look forward to engaging you further in the future. Thank you. Thanks, everyone.
Thank you.
Thanks, man. Bye-bye.